Right now, a single country controls a valve that could drain trillions of dollars from the global economy within 72 hours. And most people have no idea how close we are to that valve being turned. The Strait of Hormuz is just 21 miles wide at its narrowest point. 21 miles. That is roughly the distance you would drive to grab groceries. But through that thin stretch of water, nearly 20% of the entire world's oil supply flows every single day. We are talking about 17 to 21 million barrels of crude oil and liquefied natural gas moving through that corridor daily. If that flow stops, the reverberations would be felt in every economy on Earth within days, not weeks. Iran knows this. Iran has always known this. And for decades, Tehran has been quietly, methodically, and surgically building the military capability to do exactly that. This is not a theoretical threat. Iranian military commanders have stated publicly, on record, that closing the strait is a viable and ready option. In 2019, when the United States reimposed sanctions after withdrawing from the nuclear deal, Iran's Islamic Revolutionary Guard Corps conducted live-fire naval exercises in the Persian Gulf, specifically simulating a strait closure scenario. They were not bluffing, they were rehearsing. So let us break down precisely how Iran could do it, what it would cost the global economy, who wins and who loses in the financial chaos that follows, and what the intelligence community is watching right now that most analysts are not telling you. Iran's strategy to close the Strait of Hormuz is built on three interconnected pillars, and each one alone could cause catastrophic disruption. Together, they represent one of the most sophisticated area denial strategies ever constructed by a mid-tier military power. The first pillar is mines. Iran possesses one of the largest naval mine stockpiles in the world, estimated at over 2,000 to 5,000 mines of varying sophistication. These range from simple contact mines to highly advanced influence mines that can detect the acoustic signature, magnetic field, or pressure wave of a specific class of vessel. During the Iran-Iraq War in the 1980s, Iranian mines struck dozens of vessels in the Persian Gulf, including the USS Samuel B. Roberts, a U.S. Navy frigate, nearly sinking it. That was 1988. The technology has advanced considerably since then. A coordinated mine-laying operation in the strait conducted at night using small, fast boats and submarines could seed the waterway faster than any naval countermeasure could respond. Clearing even a fraction of those mines takes weeks. Specialized mine-sweeping vessels are slow, methodical, and vulnerable. The shipping industry would halt immediately upon the first confirmed mine strike. No insurance underwriter on Earth would cover a tanker transiting a mined strait. The second pillar is anti-ship missiles. Iran has invested massively in this capability. The IRGC Navy fields the Noor missile, a derivative of the Chinese C-802 with a range of over 120 kilometers. They have the Quadr, a land-based anti-ship cruise missile with a range exceeding 200 kilometers. And, most alarmingly, they operate the Khalij Fars, a ballistic anti-ship missile, one of the only operational ballistic missiles in the world, specifically designed to strike moving naval targets. These weapons are not stored on large targetable warships. They are distributed across mobile launchers hidden in caves, tunnels, and mountainous terrain along Iran's 40-kilometer coastline. American carrier strike groups have spent years developing countermeasures for this threat, and the honest assessment from naval analysts is that saturation attacks would overwhelm any single defensive layer. Iran does not need to destroy the U.S. Navy. It just needs to make insurers, shipping companies, and oil executives decide that the risk is too high. The third pillar is asymmetric naval warfare. Iran operates a fleet of small, fast attack craft, armed speedboats, and midget submarines. Their doctrine, which they call the Mosaic Defense, is to swarm superior naval forces using hundreds of small boats simultaneously. In simulated war games conducted by the U.S. military, including the famous 2002 Millennium Challenge exercise, the Red Team representing Iran used exactly this swarming approach and inflicted theoretical losses on the Blue Team that were described by participants as catastrophic. The simulation was reset and the rules were changed mid-exercise because the results were considered too politically inconvenient. That fact alone should tell you something about how seriously this threat is taken behind closed doors. Now let us talk about the money. The immediate economic shock of a Strait of Hormuz closure would be unlike anything the global economy has experienced since the 1973 Arab oil embargo, and it would be far worse. In 1973, the oil shock caused a 400% price increase over several months. Economists who have modeled a full strait closure scenario estimate oil prices would spike to between $200 and $300 per barrel within the first week. Some models suggest even higher figures if the closure extends beyond 30 days. Consider what that means in practical terms. The United States currently consumes approximately 20 million barrels of oil per day. At $300 a barrel, the daily cost of that consumption more than triples. Gasoline prices at the pump would likely exceed $10 per gallon within 2 to 3 weeks. Airlines which operate on extremely thin margins would face immediate existential crises. The global shipping industry, which moves roughly 80% of all traded goods, would face cost explosions that would translate directly into consumer prices across every product category. Inflation, which central banks around the world spent years trying to contain after the pandemic, would reignite with a ferocity that would make the 2025 surge look mild. The bond markets would seize. The dollar, despite being the world's reserve currency, would face enormous pressure as energy importing nations scrambled to secure alternative supplies at any price. Stock markets in Europe, Asia, and North America would enter immediate correction or crash territory. Goldman Sachs, JP Morgan, and Citigroup all have internal models for this scenario. The numbers are classified, but former analysts who have spoken on background describe the modeled outcomes as, quote, severe recessionary shock across G7 economies within 90 days. But here's where it gets genuinely interesting from a strategic finance perspective. Not everyone loses. Russia is the first and most obvious beneficiary. Russia exports approximately 5 million barrels of oil per day. At $300 per barrel, Russian oil revenues would roughly triple overnight, even accounting for discount pricing and sanctions. Moscow's sovereign wealth fund, the National Wealth Fund, would receive an extraordinary windfall. This would relieve the fiscal pressure that Western sanctions have been designed to create. It would fund the Russian military operation in Ukraine for years without strain. Analysts who track the Kremlin's strategic calculus note that a Hormuz crisis that Russia did not cause but directly benefits from is, from Moscow's perspective, close to an ideal geopolitical outcome. Saudi Arabia presents a more complex picture. Riyadh would also benefit from higher oil prices in the short term, as its production facilities are located outside the strait. But the kingdom's long-term economic transformation plan, Vision 2030, depends on regional stability and foreign direct investment. A prolonged Gulf crisis undermines that vision. Saudi Arabia's calculation is therefore more nuanced, which is why intelligence analysts believe that back-channel communication between Riyadh and Tehran remains active even during periods of public hostility. China is perhaps the most strategically important actor to watch. China imports roughly 75% of its oil through the Strait of Hormuz. A prolonged closure would devastate Chinese manufacturing output and potentially trigger domestic economic instability that Beijing fears above almost anything else. This is why China has, for years, maintained relatively stable relations with both Iran and the Gulf states. Beijing's leverage over Tehran is real, though often overstated in Western analysis. What is underappreciated is that China's strategic petroleum reserves, estimated at approximately 90 days of supply, would become one of the most valuable national assets on Earth the moment the strait closed. The geopolitical bargaining power that comes with those reserves in a crisis scenario is enormous. India faces an even more immediate crisis. India imports approximately 85% of its crude oil, and a large portion of that flows through Hormuz. New Delhi would face catastrophic fuel shortages within weeks. This would accelerate India's already aggressive pursuit of energy independence through renewables. But that transition cannot happen fast enough to prevent severe short-term economic pain. Pakistan, already economically fragile, would face conditions that its political system might not survive intact. Japan and South Korea, both heavily dependent on Gulf oil, would burn through strategic reserves quickly and would be forced into desperate diplomatic engagement with alternative suppliers, including the United States, which has become a significant net oil exporter following the shale revolution. American LNG export terminals would suddenly become geopolitical assets of the first order. Now, let us talk about the hidden money flows, because this is where the story gets layers that the mainstream financial media consistently fails to examine. When a major geopolitical crisis of this magnitude threatens, sophisticated capital moves before the public even fully understands what is happening. In the days leading up to and following the outbreak of such a scenario, you would see massive positioning in oil futures, specifically the WTI crude and Brent crude contracts on the NYMEX and ICE exchanges. Options markets for oil-related securities would see extraordinary implied volatility spikes. Defense contractor stocks, companies like Raytheon, Lockheed Martin, Northrop Grumman, and their British equivalents BAE Systems and Rolls-Royce, would see institutional accumulation. Gold and other safe haven assets would surge as capital fled equities. The Swiss franc and Japanese yen, traditional crisis currencies, would strengthen dramatically. What is less discussed is the role of state-linked sovereign wealth funds in these dynamics. The Gulf Cooperation Council states manage sovereign wealth funds totaling over $3.5 trillion combined. The Abu Dhabi Investment Authority alone manages assets estimated between $700 billion and $1 trillion. These funds have dedicated geopolitical risk desks that operate at an intelligence-grade level of analysis. Their positioning ahead of and during a Hormuz crisis would itself be a significant market-moving force. There is also the matter of shipping insurance, specifically the Lloyd's of London market and the International War Risk Insurance Framework. The moment Iranian military activity in the Gulf escalates above a certain threshold, Lloyd's War Risk Committees convene and can effectively price maritime insurance at levels that make commercial shipping economically impossible. This mechanism alone, without a single shot being fired, can bring Gulf oil shipments to a halt. Iran understands this perfectly and has at times deliberately taken actions designed to trigger insurance market responses rather than direct military confrontation. The cryptocurrency angle is also worth examining. During the 2019 Gulf tensions, when Iranian tankers were seized and U.S.-Iran tensions peaked, analysts noted unusual volume spikes in certain cryptocurrency markets, particularly assets that are difficult to trace and sanction. As Western sanctions on Iran have intensified over 2 decades, Tehran has reportedly developed sophisticated cryptocurrency infrastructure to circumvent dollar-denominated financial exclusion. A Hormuz crisis that generates massive new sanction pressure on Iran would simultaneously accelerate that underground financial architecture, creating new challenges for Western Treasury departments that are already struggling to keep pace with crypto-enabled sanctions evasion. Now for the intelligence picture and what the analysts watching this most closely are actually concerned about. The scenario that keeps National Security Council staffers awake is not a deliberate, announced Iranian decision to close the strait. That scenario, paradoxically, is easier to manage because it comes with diplomatic warning and time for coalition building. The scenario that is genuinely difficult to manage is an accidental or miscalculation-driven escalation. A U.S. or Israeli strike on Iranian nuclear facilities that Tehran interprets as an existential attack. An IRGC commander making an unauthorized decision in a high-tension tactical situation. A cyber operation gone wrong that triggers unintended kinetic responses. The 2020 killing of IRGC Quds Force commander Qasem Soleimani by a U.S. drone strike in Baghdad brought the region within hours of exactly this kind of unpredictable escalation. Iran's retaliatory missile strikes on U.S. bases in Iraq were calculated to be large enough to satisfy domestic audiences, but calibrated to avoid killing Americans, because Tehran understood that American deaths would trigger a response cycle Iran could not win. But that calculation required extraordinary discipline under enormous pressure. The conditions for that discipline to fail are arguably more present today than they were in 2020. Iran's domestic situation matters enormously here. Economic pressure from sanctions has created genuine instability inside the Islamic Republic. When regimes face domestic legitimacy crises, external adventurism becomes more, not less, tempting. A confrontation over the strait that could be framed as Iranian sovereignty being defended against American aggression might serve the political needs of the Iranian leadership even if the economic consequences for Iran itself would be severe. Iran also has significant oil reserves and can theoretically outlast a closure scenario longer than many of its neighbors, particularly if Russia and China provide economic support. The nuclear dimension cannot be ignored. Iran's nuclear program has advanced substantially since the collapse of the JCPOA framework. Analysts at the International Atomic Energy Agency have confirmed that Iran now possesses enriched uranium at concentrations and quantities that are, quote, far beyond any plausible civilian justification. The distance between Iran's current nuclear posture and a breakout capability is now measured in weeks, not months or years. A nation that achieves nuclear weapons capability achieves a deterrence umbrella that changes its calculus for conventional military risk-taking. Fundamentally, an Iran that believes it has nuclear deterrence might be a more adventurous Iran in the Strait. The alternative routes that the world has tried to develop as insurance against a Hormuz closure are real but limited. Saudi Arabia has the East-West pipeline, which can transport approximately 5 million barrels per day across the Arabian Peninsula to the Red Sea, bypassing the strait entirely. The UAE has the Abu Dhabi crude oil pipeline with a capacity of roughly 1.5 million barrels per day, also bypassing Hormuz. But combined, these alternative routes can move at most 6 to 7 million barrels per day. The strait carries 17 to 21 million. The gap of 10 to 14 million barrels per day would be unshippable. There is no infrastructure on Earth that could fill that void quickly. Strategic petroleum reserves maintained by the United States, the European Union, Japan, South Korea, and China combined amount to roughly 1.5 to 2 billion barrels. At current global consumption rates of roughly 100 million barrels per day, that represents perhaps 15 to 20 days of global supply if consumed at maximum rate, which is not operationally realistic. The actual buffer before severe shortages would be felt is considerably shorter than official figures suggest. American military planners have war-gamed the strait closure scenario extensively. The consensus from those who have participated in these exercises, including some who have spoken to defense publications, is that the U.S. Navy could reopen the strait but not quickly, and not without significant losses. Mine-clearing operations in a contested environment against an adversary using mobile missile launchers and asymmetric swarming tactics is one of the most complex and dangerous naval missions imaginable. The timeline to restore shipping confidence, even after military operations successfully clear the waterway, would extend to months because no shipping company or insurer would resume operations until a sustained period of safety could be demonstrated. The financial markets would price in months of disruption, not weeks from the first day of crisis. So where does this leave us? The world sits in a peculiar strategic position. Iran has the capability to cause economic damage vastly disproportionate to its own military strength. It has constructed a deterrent based not on the ability to win a war against the United States, but on the ability to inflict unacceptable economic pain on the entire global economy. Every major power knows this. Every major power factors it into their Iran policy. And yet the underlying conditions, the sanctions pressure, the nuclear program, the regional proxy conflicts, the domestic Iranian political instability, are all moving in directions that increase rather than decrease the probability of a crisis. The Strait of Hormuz is not just a waterway, it is the jugular vein of the global industrial economy, and Iran holds a knife to it every single day. The question that military strategists, energy traders, and government policymakers are all quietly trying to answer is the same question that should be occupying every serious analyst of global affairs. Not if there will be a crisis in the strait, but what will finally trigger it, who will be positioned to capitalize on the chaos, and whether the global financial architecture is resilient enough to survive what comes next. If you found this analysis valuable, you are exactly the kind of viewer this channel exists for. WarFinex is built for people who want to understand not just what is happening in the world's conflicts, but why the money moves the way it does when war enters the equation. Hit that subscribe button right now, and because the next video goes even deeper. We are breaking down exactly how global defense contractors and sovereign wealth funds position themselves before major conflicts go public, and the patterns are more predictable than you think. You do not want to be behind on this one.